Good morning. This is Kay Flannery at Accounting Business Solutions by JCS. We are here today to give you some tips for best practices for getting your books closed at year end. Some things to look at, some things to ask your CPA tax preparer about. You see on the screen my email address, k.flannery@jcscomputer.com, 800-475-1047. There are a lot of things to look at in your books. Today I'm going to focus on the 5 big things that I feel come first, and that if you get these tied down, then you're on your way. There are a number of other things to do, but we're going to keep it a little simpler today and focus on the biggies. So when we get ready to do our year end, we want to print. So those 5 things that I'm going to talk about are doing a bank reconciliation within your system, doing an accounts receivable aging report, an inventory value report, making a schedule or a report, a worksheet of equipment, fixtures, and furniture additions and disposals, if those need special tax treatment by your tax preparer, and accounts payable aging are the 5 on the balance sheet. Then we want to tie in our wages and tax forms. So I'm going to go through these different reports and show you the reports that I recommend and how to use them. So the first, there are 3 reports that you initially want to print. The balance sheet, that shows you what you own in assets, what you owe in liabilities, and then how much equity, stockholders, investment, and retained earnings is left, okay? So the next thing you want to print is an income statement, and the income statement is like a report card that shows you how much revenue came in from sales, what the cost of those sales were, your direct costs, and then all your various operating expenses. The third report we want to print is called a general ledger trial balance. The trial balance is an accounting thing. I tend to, and a lot of my clients, because it makes more sense, we tend to look at the balance sheet and the income statement instead of the trial balance. But the trial balance is just the sum of the debits and credits, because in accounting there's always a left and a right, just like on your bank statements. But the thing on the trial balance we particularly want to check is down here at the bottom. Do the total debits equal the total credits? You might say, well, of course, it should automatically do that. I've seen a few cases where it doesn't, and that's a problem. So we're going to ignore that for a little bit and go back to our balance sheet. So I've highlighted here the top 5 things that you want to check, and we're going to go through each one. So, and I just realized I forgot to do a report for you for the bank reconciliation. So if you are not currently reconciling your bank accounts every month without fail, you don't know what you're missing, because the bank statement shows you what went into the account, what went out of the account as withdrawals, either checks or electronic withdrawals. The bank reconciliation is taking your books, what your books say as of that year-end date, and comparing and making a little schedule or a little worksheet that shows here's the balance on your checking account plus deposits. This is in your books. Here's the balance in your books. Excuse me, I started to say that wrong. Taking the bank statement the balance per the bank, plus the deposits the bank doesn't know about yet that you've recorded in your books, less the outstanding checks that you have written but have not yet been presented to the bank to equal the balance per your books. This is number one rule. Some people don't like rules, but I do. Number one rule on accounting is to reconcile your bank accounts each month. And you say, oh, but Kay, the bank doesn't make mistakes. Banks make mistakes. The other side of it is maybe there's something you forgot to record. Maybe there was an electronic withdrawal or electronic deposit from one of your customers. So reconcile the accounts. So on this balance sheet, we have a petty cash, we have a cash on hand, we have a regular checking, a payroll checking, and a savings. We would want to do reconciliations of each of those. Count our petty cash, count our cash on hand. Secondly, we're going to look at the accounts receivable. So this number right here shows total amount of sales you've made to customers for which they have not paid you yet. They will, but they haven't yet. So we want to run a report called Aged Receivables. The Aged Receivables report shows you by customer, by invoice number, and invoice amount, who owes you what. So this is one of those sum of the parts has to equal the total rule. So you don't want to just say, oh, I'm owed 180, whatever that number was. You want to know who hasn't paid me. So part of looking at this report is looking at who has older balances to follow up on those. Well, why haven't they paid? Let's get on the horn with them or send them an email with a copy of the invoice. Have we missed your payment? Here's a copy of the invoice. And get that stuff collected. So on this report, there's a total down at the bottom, $183,117. So if I flip back to my balance sheet, they agree. So I could put a big old check mark right there. I'm going to put an X because I don't know where the check mark is. Now, when I first opened this data, those did not agree. So I was able to run a tool within the Sage 50 to find where those differences were. So if they don't agree, you've got a problem with how some things are getting coded and you need to track it down. This is a monthly procedure also. It's very important at year end, but it's particularly also on the age receivables. In this case, we don't have any old stuff, but you may want to look at if there is very old stuff, does it need to be adjusted off as bad debt? I wouldn't do it prematurely, but you may want to think about it. Moving on, when we look at our balance sheet, the next thing I have itemized here, highlighted, is inventory. So at year end, you want to go out into your warehouse, if you have inventory, and count everything you've got. So you count, you've got a cost on it, that count times the cost equals the inventory value. In the program, Sage 50, there is a report called Inventory Valuation. Shows me my item ID, the name, cost method, how many I have on hand, and the value. What I'm looking for here initially is, does the total, let me back up. After I've gone out in the warehouse and I've counted all my inventory, I'm going to want to come in and make inventory adjustments. One of the functions within the program, inventory adjustments to get my books to agree with what the actual physical count was of my inventory. This is very important because you don't want to have any surprises. If for some reason there are big differences, it means either inventory is walking out the door without being recorded as a sale, or inventory isn't being received correctly, or any number of problems. So I'm looking first at, does this total on my inventory valuation report agree with my balance sheet? And in this case, this data has a problem. Those two numbers should agree. So I would need to track that down and use the tools that are in stage 50 when you change periods to, there's a month-end review little wizard that works really well, and it can tell you which things might be coded incorrectly. So this data has a problem. This looks like data I get from my clients sometimes. Also, back on the inventory, I saw something when I was flipping through here. Up here at the very top, it shows that I have a negative quantity on hand and a negative value. You need to look at those and see what's going on with those. Why do you have negative quantities on hand? That's a great big no-no. You need to receive your, excuse me, you need to receive your merchandise or make your assemblies, your bill of materials, into the finished goods before you create the customer invoice. Because no accounting system will keep your costs correctly if you're allowing negative inventory. If you don't know how to fix it, that's why we're here. So those are some red flags for me of what do I need to look at here and what's going on that I have negative inventory. Okay? Moving back again. So I would want to track that down. Either my valuation report is somehow wrong, or there's coding incorrectly in my books, the way the transactions are going through with my debits and credits. I'll just give you a quick example. Oh, that's on that. Never mind. Moving on, property and equipment, furniture, fixtures, equipment, vehicles. Your tax preparer needs to know, did you buy any additional assets? Or did you dispose of any assets that need to be handled on your tax return? So furniture, property, fixtures, equipment, those are things that have to be what the IRS calls depreciated. That means that that cost is spread out over the life of the fixed assets. We call them fixed assets. You could call them property and equipment, but whatever. They're tangible assets that are owned by the business. So to give you an example, vehicles, say you bought a new vehicle this year and it needs to be depreciated over 3 years. You'll want to provide the documentation to your tax preparer on the vehicle you bought, what it cost, what the sales tax and other costs were, and you will need to also tell the tax preparer if you traded your other vehicle. So there's special ways that trades need to work on the tax return. If you're not sure, I tend to tell our clients to put things you're not sure of in a suspense or an ask accountant category, because it automatically creates a list of all your questions that you can then easily go back to. I don't have a schedule to show you on property equipment from the fixed asset program, but typically you're just giving your tax preparer copies of the invoices for the purchases and documentation of the disposal or removal from your business. Moving on down, the next in my top 5 is accounts payable. So accounts payable are the things that you have purchased from your vendors and you have not paid them yet. So typically you might have net 30 days terms that when you receive the merchandise, you want to record it into your books, and then you're going to pay the vendor in 30 days for their terms. So the accounts payable schedule, or it's called an aging, because we're showing the age of the invoices we have that we owe for. And again, it shows us by vendor, by invoice number, by invoice amount, and age, what we owe. So again, this is a sum of the parts. We don't want just a big fat number on our balance sheet. We want some supporting documentation. For accounts payable, the aging report is that supporting documentation. So the primary thing we're looking at here is, do we really owe these invoices? You know, if for some reason we're not going to pay them, or we have a dispute, we need to get those worked out. So we've got a few old things here that either we need to pay, or we maybe have gotten approval from the vendor that they gave us a credit because the order was wrong, or we returned it or something. So you're looking at reasonableness on this report. And then here again at the bottom, we want to look, does the total on this report agree with my balance sheet? So popping back over to my balance sheet, remember this number, 98,010.51. So I've got a problem. So this is really good sample data that I happen to pick because it's got problems in it that I would want to track down and figure out what's happening. Because something's not getting coded correctly. Okay? So those are my top 5 things. And number 6 is, on the income statement, we want to look at the wages expenses and run our payroll register report and verify that our total wage expense on our books agrees with the details of our payroll registers. We also want, related to tying that in, we want to look at our quarterly Form 941. That's the one you do each quarter that shows how much wages you paid that quarter, how much federal withholding you withheld, how much Social Security and Medicare you withheld, and your matching employer. And you want to be sure the sum of those 4 reports agree with the totals on your W-2s that you're issuing, and agree with the reports that you filed for your state unemployment, that's SUTA, or your federal unemployment, and your withholding. Very important. Better for you to do it now than give the stuff to your CPA and have them have to track it down. Okay? Related to W-2s and forms you need to file, dates. There are dates that certain things need to be filed. One is W-2s. Those need to be mailed or distributed to recipients by January 31st. And government copies submitted, they prefer electronic, by January 31st. The second on the due dates is Form 1099 MISC. This is the one you use when you have paid an entity, usually an individual or a partnership, for any entity that's not a corporation, that you have paid them for services. You don't issue 1099s on merchandise or inventory you've purchased. but you issue it to non-corporate entities for whom you have paid services. Those 1099 forms are due January 31st. Both they need to be distributed or mailed to the recipients by January 31st, as well as you need to submit them to the government by January 31st. In the old days, a few years ago, you didn't have to submit the 1099s and W-2s to the government until February 28th. They changed it a couple of years in an effort to prevent fraud. So that's a major rule change that went into effect last year. The next dates for tax filings are March 15th for your corporation return. That's a Form 1120 or 1120S. Those forms are due March 15th. If you are not ready and do not have your books in order, you can file a specific form, of course, for an extension. That extension must be submitted before the due date, March 15th. That extension is an extension of time to file the form. It is not an extension of time to pay the tax. So related to that, you'll look at what taxes you paid in, and with your CPA tax preparer, determine some estimate of what your tax liability is for that year, and what estimates you've already paid in, and pay in an additional balance, because the extension is only an extension of time to file. It is not an extension of time to pay the tax. There are separate penalties for not filing the returns and not filing the tax. The next due date, and similar rules apply, are April 15th for the individual tax return, Form 1040, or maybe you have a partnership or an LLC that file Form 1065. These are due April 15th. And again, you can file an extension, must be submitted to the IRS, and your extension might need to include additional tax due. And similarly, interest and penalties apply separately for failure to file returns and failure to pay the tax. So those are your due dates. On this balance sheet, if you really want to get fancy, or you want to know what's in your books, you would want to check the schedule and make a schedule of what are all these other things on my balance sheet. What do they consist of? So maybe you have other accounts receivable. Maybe this is, for some reason, some other kind of a receivable that is not part of your normal ongoing business. Maybe prepaid expenses. Maybe you paid your whole premium for your general liability insurance, say on September 1st. You've only used 8 months of that premium, so you have a prepaid for 5 months. And each of these accounts, you want to know what's in there and make a little schedule, a little report, a worksheet of what those are. Similarly, on the other assets, what do you have in deposits? Maybe that's first and last month's rent on your lease. Maybe you're amortizing your organizational costs that have to be amortized over 60 months. Maybe you have some other kind of note receivables or other non-current assets. All the way down the balance sheet, you're going to want to look and see, okay, do I really owe this at December 31st? What's that amount? Have I made sure that I've paid it by January 31st? Wages payable, do you have any accruals? say your period at the end of December cut off on December 26th was the last period end date, last payroll paid, but you have to book the amount of accrual for wages for the 27th through the 31st. Did you pay in all your 401k contributions? Why is this health insurance payable have a bracket on it? That means you've paid in more than you've withheld. Payroll taxes payable. Have you paid all the taxes for the year? So all the way down, your tax preparer wants to know, are these balances reasonable? What do they consist of? And what are you going to do about them? When are they going to be resolved? Looking at the income statement, we've already talked a little bit about tying in the wages to our payroll tax returns. We want to look at how did we do this year compared to how did we do last year. And I've made this report that just shows year-to-date this year, year-to-date last year, in the increase or decrease. On a monthly basis, you might also want to see the columns for current month this year and same month last year in the variance. So you want to be looking at and thinking about and understanding, why did these things go up or down? Either you change the way you're doing business, or you change the way you're classifying these things so they're not exactly comparable, or it was a bad year or it was a good year. You never know. But you do want to know how you're doing compared to the prior year. Cost of goods sold. Looks like I've got a problem right here with some bracketed amount. Maybe that's supposed to go somewhere else. Maybe that's supposed to go in discounts or whatever. If I was in the actual program and not in the Excel spreadsheet, I would drill down on that and figure out what that is and see where it needs to go. On my expenses, how am I doing managing my expenses? Why are certain things going up significantly or going down even significantly? Because you want to know, where's your money going? Because how much you have at the end is what can ultimately get into your pocket. So the income statement is like a report card that zeroes out on January 1st of the next year, and that net income rolls over into your balance sheet, and we see that same number right here on our balance sheet, net income for the current year. That's what I have to say today. I'm Kay Flannery at JCS, Accounting Business Solutions by JCS, K.Flannery, jcscomputer.com, 800-475-1047. We do have time for a few questions if there are any. Okay, here's a question that came in. Okay, I've got all these problems, but what do I do with them? Well, your CPA tax preparer, if they are familiar with your software, can help you track down these issues. If they are not, and they just want to get the final numbers, the team at JCS has tons of experience and intimate knowledge, unfortunately too intimate knowledge, of the software, whether you're using QuickBooks, Sage 50, Sage 100, or some other, the accounting programs work the same way. So you want to track these things down and know what's in your books. Anytime I hear someone say, oh, I don't know, my bookkeeper takes care of it, they are opening up themselves to fraud. If the bookkeeper knows you don't know what's going on, it's a perfect opportunity. The intersection of greed and opportunity equals embezzlement. Another question that we got is, how do I figure depreciation on the vehicle, and how many years am I allowed to take depreciation on it? Generally, vehicles are 3 years. There are exceptions depending on the size and weight of the vehicle, and a whole bunch of other complicated rules. What you mostly want to do is make your CPA tax preparer aware of these asset additions or removals. And typically the tax preparer calculates the depreciation. And so you don't need to worry about having a depreciation program and knowing all of those rules. When they complete the tax return and they give you the tax return, you want to take that tax return and have the CPA tax preparer give you their adjusting entries where they recorded the depreciation or they reclassified a few things, and record those so that your balance sheet at the end of December agrees with the tax return. This will save you money because then the CPA doesn't need to adjust for it the next year and the next year. And you see the things that they're adjusting so you can figure out if there's a better way for you to do it. I do have a question about Section 179. That's a specific tax rule that I'm not going to answer because there are all sorts of variables, and that's really a decision to be made by with you and your CPA tax preparer as to how to handle for tax reporting the best results to meet your business needs. We're focusing today on how do I keep my books in order and what do I need to look at on an ongoing basis. So if you focus on those 5 top things that I identified at the beginning of the session, bank rec, accounts receivable, inventory, equipment, additions or disposals, accounts payable, you have the bulk of the work done and you can track down the rest of it. That's all the time we have for today. This is Kay Flannery at Accounting Business Solutions. We look forward to working with you.
Very good.
I haven't